you will find that the attitude towards various investments has changed significantly over time, and things that you thought were dead become huge winners. Things that you thought were winners don't pan out. That is just par for the course. So you need a flexible strategy, because something may be worth investing in, and you need to have reserves, even if it hasn't broken through in the time frame that you had in mind.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. This week, we're talking to Amol Deshpande, who raised $900 million to disrupt agriculture with Farmers Business Network, after being the first investor in Beyond Meat while at Kleiner Perkins. Amol, thanks for joining. I appreciate you being here.
Oh, for sure. Great to be here.
I want to start right off the bat talking about investing, and we'll get into building companies and fundraising after that. But on the investment side, what is your best investment of your career?
Best investment, the one I'm known for is Beyond Meat. That was 2009 timeframe. I was at Kleiner Perkins. This is a period of time where we were very interested in green tech. It actually wasn't going very well on the energy side. And, I actually love meat. I'm not a vegetarian or anything like that. I just saw technology that had the potential to replicate the texture of meat. And we went and made that very first investment when it was still in a lab. And frankly, people thought it was ridiculous. I know that these things are everywhere today, but that ended up being one of the best returns ever in Kleiner history.
What was the entry valuation on that one?
It was in the $2 to $3 million valuation range. Look, 16, 17 years ago, when you did a seed investment, you were willing to take the risk pre-revenue. And it wasn't this, I don't call them venture capitalists anymore. I call them venture analysts, because the old days, you would look for a breakthrough technology, a wonderful team, and you would say, look, I'm an entrepreneur investing in another entrepreneur. That's how it was old school at Kleiner Perkins. And that's what we used to do. So the valuations reflected the fact that it was merely an idea, right? But that is how venture capital used to be done. And then your job was to invest and breathe life into the company.
Do you remember off the top of your head what the exit multiple was on that investment?
I don't know exactly, but it was gigantic, because I don't know when all the distributions and other things happened, but ultimately, at some point or another, I'm sure the returns were high hundreds of millions, billions of dollars. I don't know exactly.
Yeah, the IPO was, I believe, in the billions, right? So at a $2 to $3 million entry point, that's a pretty good multiple.
Yeah, and you invest along the way. Although a lot of investors back in those days used to make the decisions to, today the world has become, power into your winners and do more in the later stages with these bigger funds. Multiple of money was a bigger thing 2 decades ago, and I don't necessarily think that was right. I mean, return that's $1 billion. If you didn't see, you thought a $5 million or $10 million valuation was fine, but then $100 million you didn't invest. If the company exited at $3 billion, $5 billion, $10 billion, that was a mistake. If it's a winner, it's a winner, and you ought to support it, because a venture portfolio has way more losers than winners. So when something appears to be differentiated, has that real kernel of potential, I think you go for it. And so I think the new philosophy in that way is actually better and results in those much bigger returns from those, multifaceted firms.
Yeah. I've been surprised actually how opinionated people are about having a no reserve strategy or a concentrated reserve strategy or a programmatic, 50-50, 1-to-1 reserve strategy. And I've seen great funds, great firms with all strategies. So it does seem like they can all win depending on your strengths and weaknesses. It doesn't seem like it's something you need to have religion about.
I don't think you need to have religion. In fact, I think being programmatic about it is absolutely a mistake. I do think every investment is a new decision. But, look, some of the biggest winners come from things that you really don't expect. If you look at a portfolio in a venture firm in 18 months into that fund's life, and then 3 years in, and 5 years in, and 7 years in, you will, and then 10 years in, and then 15 years in, when you've actually, even then, sometimes you haven't finished distributing everything, but let's say you have, you will find that the attitude towards various investments has changed significantly over time, and things that you thought were dead become huge winners. Things that you thought were winners don't pan out. That is just par for the course. So you need a flexible strategy, because something may be worth investing in, and you need to have reserves, even if it hasn't broken through in the time frame that you had in mind.
What was it that gave you the initial confidence to say, I'm going to go out and look for someone doing this before you found the Beyond team?
I actually was looking, what I wanted to do was, I had asked my bosses at Kleiner, who were these, at that time, again, VC was much smaller. And the way it worked was you worked with a senior partner or two. And I worked with people like Joe Lacob and Ray Lane. Those were two bosses of mine, John Doerr, on various investments. And in this case, I was working with Ray. And what I told him actually was I wanted to find an investment where we could actually build a platform that had all of the most elite animal genetics in the world. Because my view was that, with breakthroughs, not only in computing, but in sequencing, you could know more about the genetics of an animal and addition of biomass than ever before. So I was looking to put together a team to actually build a portfolio of cattle, hog, chicken genetics, aquaculture genetics, that could then be licensed to farmers, to institutional livestock producers, to kind of make the growth more efficient from a biomass perspective of the animal.
Yeah, like take the work that's been done in seeds for a long time, and like the work with traits, and just apply it to livestock.
Well, that's exactly, because I'd been an entrepreneur in the seed side of them. I'm still on the board of a very successful seed genetics company, by the way, which will be another big winner soon that a lot of people don't know about. But that was exactly the genesis of that idea. And the problem was that I couldn't find anybody to run that business. Like, it turns out that it's a bit more complicated than it looks, right? You need to find those, you need science background, you need a livestock background, you need from a marketing perspective, you need background in terms of how you would license to farmers, how would you put all these things together. It was harder than it looked. So after a few months trying to do that, I just happened to stumble across a paper around extrusion, right? And the potential of technology around extrusion to replicate the texture and the mouthfeel of meat. And I decided to go take a look at that. So it was really almost like based on a different idea in the livestock industry that led to that.
And when did it go from something you were investigating to something that was like an investment you have to do?
When I saw the lab and the prototype, I sort of thought to myself, like, this is a gamble we have to take. Remember, in the old world of VC, 90% of your investments were expected to fail. There really wasn't anybody who was bragging about, I have no write-offs. It was more like, and we had this thing called this Grand Challenge Initiative, which a fellow named Bill Joy, who was one of the founders of Sun Microsystem, had set up. And the Grand Challenge thing was around testing the limits of science and technology, right? And he was really into the limits of science. So a windmill that could beat the Betz limit, a super high efficiency solar cell. And here I saw something that I felt was a grand challenge, right? That could you actually do this? I actually didn't even think it was possible, which is why the investment had to be done in the way that it was done to begin with. And I guess 15 years later, you might suggest that it isn't possible because, while those things have gone on a roller coaster ride and there've been some returns, in this moment, I'm not sure I'd go back and say that the original thinking on all that worked. But the premise was to get the price below the price of meat, which never actually happened. It still hasn't, even with all the new cell meats and cell-based meats and all that other crap that's popped up. So it was very clear to me that the risk reward made sense, but 9 times out of 10, this would fail.
Do you think that looking 10 years forward, whether it's something that has the look and feel but is plant-based, or something grown in a lab or a vat, do you think that those types of technologies are going to supplant traditional meat, or no? If you look at
No, I absolutely think they will not. As I told you, I love the livestock industry. I actually think livestock is very interesting. The genesis of Beyond Me was interest in livestock. I worked on a livestock operation in grad school, and kind of how I got into agriculture. So I actually never believed you would supplant meat. But now I believe that actually, when you really drill down into the particulars of the whole impact, right, on human health, on the environment, on society, on farming, on the farming community, everything else, I think plant-based is really a niche, and I think cellular and these other things are a fantasy. I don't even know that technologically or scientifically they can work, much less from a market standpoint. So I don't see any hope for those. I think that that category of investment in ag, along with vertical farms and some of these other sort of ridiculous things, I think they were more like venture capital fantasies ultimately at the end of the day. They weren't like premised on real understanding of a food supply chain, a future that has whatever 8, 9 billion people, around human health and the impacts of all of these products on human health. So those are factors that matter. It isn't just the feed conversion or the most basic climate characteristics of these things that are important. You have to look at the whole picture.
Yeah, that's a fairly contrarian view. But then so again was investing in the first place and beyond. So
Well, so from someone who was maybe the only person in history to actually make any money doing those things, and so, but the reason I'm saying that is because it's the truth. I know that in Silicon Valley, it's very vogue these days to say cellular, plant-based, vertical farm, all this other stuff, but these are fantasies. Like they're not, and even if they worked, I don't, which they won't. I don't know that the impact is what people think it is, right?
the track record's pretty bad for some of these, right? The number of companies that have failed and shut down. I don't know anyone who's actually reached price parity or good unit economics in these sectors either.
No, they haven't. It's been a lot of bluster, and it's just a fact. Look, my memo that I wrote years and years ago was, can we get below the price of meat? And the answer is no. And you also can't match the health characteristics. You can market it in a way that makes it seem like it's more planet friendly. But you know what? I know a lot of livestock producers too, and some of them farm in these regenerative ways and other things that actually they take the soil and the impact to the earth fully into account. And those operations are actually pretty phenomenal. And there's quite a bit of that, and there's movements towards that right now. So and it was never that premise. It was really just, look, this could have an impact from an environmental perspective. There is a market for it. And if you got the price below and you got the texture to a point where it was similar, you've seen what's happened with broiler chicken and other products. It can happen. Vertical farms, same thing. Vertical farming is that was one of those sillier concepts that I've seen VCs fund. For example, I'm on the board of a company that does breeding for indoor environments for vegetable seed. And it's one of the most successful ag tech companies around. Nobody's heard of it. It's called Axia. We're going to make huge earnings this year. It's like a pharmaceutical grade scientific breeding facility, and they have a tomato variety that's resistant to brown rugose virus, which is the most common virus in an indoor tomato operation today. And they're becoming the market leader, and that's causing them to be not only very profitable, but they're going to be a very valuable company. So those are the things, like the fundamental scientific things that break through and really change the game for a farmer or for a consumer. Those are the things that turn into huge companies, I think, at the end of the day.
Yeah, from the outside, they might look more incremental, but when you actually drill down, they're very big inflection points.
Yeah, and a vertical, like, again, I come back to like a vertical farm. I mean, building vertically, I never understood the point of that, for example, where you have things like Dutch style greenhouses that have been around for decades that are perfectly efficient. And I'm not actually, indoor farming is a great idea. I don't understand why you do it vertically.
Yeah,
or
separation between indoor farming and
vertical.
Like
These ridiculous, like, contraptions that they claim they're going to license to people and other crap. Like, it makes no sense.
Let's go back to 2009 when you come back to your partners at Kleiner Perkins and you're like, "Hey, I found this company and it's plant-based meat." What did they say? What was their response?
I think everybody thought it was sort of preposterous. I mean, I don't think there's any doubt that it wasn't like, oh yeah, this makes perfect sense. I mean, remember, in the world of green, there was a green and environmental movement that happened post Al Gore's book, Inconvenient Truth. There was all kinds of people throwing money into, venture capital investments in renewable energy. So bringing a solar company or a wind company or a geothermal company, that seemed perfectly normal. And a biofuels company, I mean, biofuels, I would have never thought that would be a venture capital investment. And I was at Cargill before Kleiner. I was shocked that Silicon Valley VCs were doing this, but
was Al Gore a partner at Kleiner Perkins at the time?
He was, yeah. Joined within a couple months before or after I did, actually. And when his book came out, and there was a lot of movement to invest, but to be honest, those things seemed perfectly normal. Like going and investing in the food chain, that was viewed as abnormal, meaning I think people were like puzzled by what impact would that have? How is it quantified? Why would a consumer adopt it? So no, it was I think viewed as sort of silly, but it was also a small ask, so it was approved.
Was there any feedback that turned out to be prescient in looking at how things have played out over time and how you think about the world now?
No, no, it's amazing, but in the moment, the best investments are ones that usually people think are ridiculous or don't like. I'm not saying I was prescient, but my own view of it was dispassionate in the sense that, as I mentioned, I actually like meat. It wasn't necessarily about all that stuff. I tried like vegetarianism and other things, and it just didn't work for me. It was more like, okay, can this be done? Because when you look at broiler chicken, when you look at what was happening in aquaculture, those are things that over decades have grown into huge, huge industries, and they started from nothing. And the key to that was animal husbandry, right? And the need for low cost, lower cost protein. So that was the premise. It wasn't a whole lot else. Just like as simplistic as the premise of a more efficient solar cell or a more efficient wind turbine. So no, I don't think there was anything prescient. And the one thing I will tell you is kind of a funny story was shortly after that, Impossible Foods was formed by Pat Brown. And Pat Brown actually was a professor at Stanford, a very brilliant guy, one of the inventors of the DNA microarray, very passionate too about this whole cause, or what he viewed as a cause was plant-based food. And he actually came and heard that we were the ones who had invested and wanted us to invest in his company. And there's a kind of a funny story about how that didn't turn out. And Vinod Khosla and his firm ended up doing it. But there was a point in time where Kleiner Perkins could have funded both beyond an impossible at that stage.
That wouldn't have been against policy as far as like competing investments.
No, there weren't policies, and there were different approaches. I mean, the approach of Impossible, I mean, was distinct from that of Beyond Meat, which is, one was mechanical, another was based on sort of a different concept in terms of mimicking the hemoglobin with leg hemoglobin and some of these other things. So there was a very different approach, but it wasn't a policy issue. It was just how many of these are we going to invest in, guys? I mean, it was perfectly okay to invest in 5 solar companies, but investing in 5 ag businesses or alternative protein or this or that didn't seem to make any sense.
I've always wanted to ask you, how did you end up so deep in the ag industry as an Indian American? I feel like there's not a ton of folks with our background in the industry.
I was, born in the Chicago area. My dad was an environmental engineer, and after I graduated from college, a few years after, I was going to grad school, and I sort of like wanted to get into being an entrepreneur. I already had done some things, but sort of small potatoes stuff. And I asked him for help, and really he didn't know a lot of people. My dad's like a lifelong engineer. He's not a networker or that kind of guy. But he happened to have been working with somebody who was a very successful ag entrepreneur. His name was Paul Salou. And this is a fellow who's actually now CEO of one of the biggest indoor farms in the US. It's called Little Leaf Farms. And this was 20 plus years ago, but he hired me to work on a fish farm that he had raised venture capital funding for and was trying to grow. We were growing tilapia indoors. And that's sort of what kickstarted my interest in it. I got to work there, and I was pretty fascinated by the whole thing, right? The genetics, how you could grow a Nile River species in upstate New York, the feed and the feed rationing, the production of that biomass, and then ultimately, how that's processed and brought to market. I was really amazed by it. I thought I was going to hate it. I was like, an engineer. I was thinking, gosh, I should probably be in software or tech or going, but I just wound up there, and it was by now, as I look back, good fortune, and I loved it and sort of stuck with it.
Yeah. So you knew in that first instance that like that pull you had really resonated. You found what you loved.
It was just fun. I mean, it was just too much fun. It was a lot more fun than, say, enterprise software sales. I mean, I was looking back, I'm probably starting a handful of enterprise software businesses over the last 20 years might have been more lucrative and less painful journey than the one I've been on. But I would say that this has been what I wanted, and it's also been fun and intellectually stimulating.
I had a job on a farm when I was in high school, and that was enough for me to say, this is not for me. And obviously, being a hand on a farm is a little different than being an entrepreneur, but it was brutal. It gave me a lot of appreciation for the work that goes into that.
Well, but what's funny, and I mentioned this a lot about farming, is that despite that, not having grown up on a farm or looking different than others, I just find that community to be just amazing. Like I've been to probably more farms and no more farmers than anybody in the world. And not only, do I feel welcome, I feel part of that community. That's why I love doing business in rural America. That's why I love, being innovating in that industry. I've just always found it to be a place like I could have grown up there. I didn't. I grew up in a major metro area, but my experiences there have been just utterly positive. It's another reason that I stick with it.
Yeah, well, let's get into that, right? So you're this is like 2009. You're at Kleiner Perkins, one of the best venture firms in the world, working with people like John Doerr and Al Gore. And at some point after that, you decide to leave and start a company. What was it that led to that move?
I was fired. I mean, venture firms change, and at the time, people didn't know that investments I made were going to be enormous winners. And as you know, there's always various reasons why venture partnerships and other things shuffle around or move around. But at that time, Kleiner was going to go back to being more of a consumer and enterprise software team. Like for me, like just being a venture capitalist in that kind of an environment is not that interesting, nor am I the best at it. So, I mean, if that's what firm's going to be, then it's probably not a fit, right, for me. So it was either I start my own firm, which a lot of my colleagues did. I mean, over the years, the number of ex-Kleiner people that are in venture firms or started their own platforms is just incredible. A lot of old friends and colleagues of mine who are just awesome, and they have their own funds. We stay in touch, regularly. But I chose a different path. I thought to myself, look, I was still young enough to go back and try to be an entrepreneur again, and seemed like the right move to start a business as opposed to continuing an investing career. But no, I was fired, and I don't know. I might have moved on anyway, but it was just now in retrospect probably good timing.
I guess the question then would be reframed to what made you decide to start a company in this specific field, or in the one that you did, versus starting anything else?
You want to go, if you're going to start a business as an entrepreneur, I mean, you want to go where your skills are differentiated. And for me, that without a shadow of a doubt, 10, 11 years ago, that was the ag or ag tech industry. And there's no doubt about that. And that was an easy decision. Now the question of what to start and, how to do it and all that other stuff, I mean, it's not that I don't have passion for other things. I mean, I'm now, as you know, a CEO of a health tech startup, and I invest in a lot of things out of my family office. But at that time, it was pretty obvious. Like if I'm going in and starting a company, it's going to be in the ag industry. Now, what to start from a tech standpoint? There was a lot of things happening with cloud computing, data and data analytics across industries, but including ag. And I just felt there was an opportunity to go back to that farm level. That was kind of the part of the supply chain that I want to be in. I didn't want to be in the CPG side or the alternative meat side or all these other random things that were there at the time. I felt this was a better approach and where I wanted to be. So actually the same firm that fired me, Kleiner Perkins, also gave me a blank check to start that business. And that's how we started FBN ultimately in 2014.
What was that conversation like in terms of getting that blank check? Did they know you wanted to start a company, obviously, and they were happy enough with you and your performance to say, yeah, you'd make a great entrepreneur, or what was it?
Yeah, I mean, once you've worked with someone for a long time, you know whether they're gonna like make a good entrepreneur or not. I mean, I also my old colleagues like who are running funds today, for example, I would invest in them. I have in some cases because I know they're good, right, at their job. I work with them long enough to see how the access they get, how they think about things, how they'd invest. The same is true as an entrepreneur. If you work with someone for a number of years, so I think that was a pretty obvious bet, right? I definitely knew the trade. I think if I had showed up and said, I'm going to start a healthcare business at that time, 11, 12 years ago, they might have been scratching their heads. I think in the ag space, that was sort of an obvious decision. So I think that people knew that and thought that it might go quite well, especially with the backing of good investors.
I want to ask you about this, about being a founder as well, but what is it about you that made you a great investor? What do you think made you talented in a way that stands out on that front?
Well, I don't know if I am a good investor or not. Like I don't look at, I would say that if you look at the aggregate of the returns I produced relative to the money that I deployed, right, as a lead investor, I would think most people would say I'm a good investor. I think that in venture capital, the reason I could do a good job is I am willing to take risk. I'm willing to see a big idea. I understand deeply how those portfolios should work, right? As a limited partner, you don't invest in a venture capital firm for no write-offs. You invest for 50x. They have LP limited partner. They have a lot of other investments that are safe. Here, you have to produce something unique. So I think, I would guess if I would have run a bunch of venture firms, I probably would have made a lot of bad investments. I did make bad investments, but would have probably still made some that were big returns too. And a lot of that comes down to willingness to bet on a big idea, a bigger thinking entrepreneur. But remember, some of those people also crash and burn. And some of those ideas also crash and burn for a lot of reasons. And so I don't know if I was good. But I would say if in venture capital specifically, I would say it's that the willingness to take the risk, build to big ideas, and then also as an entrepreneur myself at the early stage, being able to breathe life into companies, right? Really get in the details and help an entrepreneur recruit, help them raise money, help them work through their business plan. I still do that today with all my personal investments on a regular basis. And that's what I enjoy most about investing, like actually trying my best to add value to the team. And that's how I gained a good reputation at Kleiner is I worked my butt off for entrepreneurs. I would do whatever I could to help them and support them as a VC. And your scope and what you can do beyond investing is pretty limited. But if you can do those certain things well, then you can be a good early stage investor. Because if something has potential, it is your job to breathe life into it. And if you can, then those emerge. They create value, and you're in at an early stage. The math works.
Was that first round that you raised there from Kleiner as you started the company the easiest one you've raised, or was there a round even easier than that?
No, well, we got preemptive proposals multiple times throughout the way. It was only easy in the sense that I didn't do a lot of meetings because I took the deal. I don't know if that was a good idea or a bad idea in retrospect, but I think if I would have said, okay, I'm leaving Kleiner Perkins, look at my track record from an ag standpoint, my knowledge, I think I could have gone and raised plenty of money from other people too. It just happened to be something where these are people that I knew, and it was made sense. But so in that capacity, it was easiest. But in terms of the proof points in the company, there were none. I mean, it was just, we were just incorporating the business at that time.
Yeah. Which subsequent round would you say was the easiest?
I would say Series B. At that time, that was 2015 timeframe or so. We had a lot of interest because the ag tech industry was still relatively new. There weren't that many players, and we definitely had meaningful traction. We were a standout player with a good team, and that round ended up being led by Google Ventures. It wasn't easy to get them. I mean, they are tough to get on board from a high bar, but our company had quite a bit of very obvious merit at that time. So it was really just a matter of who was going to invest and what the terms were going to be. So I would say that was probably, from the standpoint of knowing you're going to get financed and in a way that's pretty good or pretty reasonable, that was probably the best round.
What was the vision or the pitch at that time at the Series B?
It's pretty different than what the company turned into. I mean, what we were ramping up was our original data analytics product, which is this aggregated data product that we had originally built, where farmers contribute information. We're able to take that spatial data and turn it into this incredible amount of analytical information that's very useful if you're selecting seed or purchasing a new product or whatnot. So that community approach to data, given there's 1.8 million farms in the US, that was the thesis, and it was the data and the contribution of data that was really scaling at that time. We were pretty early in our monetization.
Shifting gears, and what turned out to be the hardest round for you to raise?
In the middle, before we were really late stage, the Series C, Series D rounds, those were harder because you always had some scale as a business, but you weren't quite ready to be a public company, for example, yet, right? You didn't have that level of team, infrastructure, capital, revenue, whatever it is. And so you were back to sort of selling a vision, but you were having to convince investors who are altogether more conservative, right, than the early stage investors are, and have to underwrite to a plan. And there's the diligence I tell entrepreneurs this all the time, the diligence in a Series C or D round is 20x. At least it used to be. I don't know these days, but what the diligence is in a seed round, right? Now, as you get even later, you get to the point where you're in a public market, then it's a little bit different. You have all kinds of information available at your fingertips. You have an IR team, you have a whole management team. It's much easier to produce information. So probably those middle rounds, those are the ones that are the hardest. Seed A, B, what you see in D rounds, or then when you get to later stage, it's rounds, pre-IPO rounds. They're not easy, but it's kind of a different model for how those get done.
If we take the Series C, what did the funnel look like for you in terms of how many folks did you have to talk to at different firms to get to a first offer, and how many offers did you have before you actually got to a final close?
Gosh, I don't remember the particulars, but I think that was led by an insider. And so that might have been around where before we went to the market, an insider said, well, why don't we work something out here, right? And I think we took that approach. The Series D was a very seminal round for the company. We brought in T. Rowe Price and Temasek, and that was in a period of time where there was players like SoftBank, for example, in the market and others, and we actually got proposals from a number of different parties there. That round was quite interesting because the market we hadn't gone into a super hot market yet, but it was kind of a period of time where that later stage and the mutual fund and other companies had come into the private market. And so that was the first sort of 9-figure round that we raised. And that one, the funnel was actually not so big and we got to multiple offers. But the reason the funnel wasn't so big is because the size of capital we were going for was only so many parties you could go to. And then right around that time, it started to explode, like the number of people who were either writing bigger checks. Every mutual fund company, T. Rowe Price was like the first to start doing private investments. But then by 2 years later, everybody was doing it. And so that quickly expanded the universe of people you could go to, right, for a later stage.
What was the most unexpected piece of the process? The thing that was just like felt out of left field?
I don't know if there was anything that felt left field. I would say the part of it that the rigor of the financial diligence, as an early stage entrepreneur, you're used to kind of making plans, and we already operate. Ag is a volatile industry. Like you can have very, very good years, you can have very, very tough years. It's sort of part of the game, and most ag businesses know that, and people in that industry know that. But remember, as a tech company in ag, you're attracting a lot of different kinds of investors, including those who are outside the industry, and they may not be as accustomed to that kind of volatility or understand why it happens or that it's unavoidable, right, in some cases. And so the part that was the hardest was really kind of the degree of financial diligence, explaining things like seasonality in the business, how the ag business really, really works when you have people who haven't invested in it before, right? And it can be exciting for the growth, the interest in the business and the potential to build something meaningful, but it can also be a little bit scary because it can be a volatile business too. It's a business that's inherently subject to volatility.
Yeah, this is sort of like the education of investors to some degree of the nature of the business model and the industry in ways that are different from SaaS, for example.
Versus something enterprise software, right? I mean, we would constantly run across investors in enterprise software who would try to bucket the company in that way, and they would say, well, why is this quarter so slow? Well, farmers aren't buying their goods in this quarter. Well, that's not how it works in software. Is sort of like clockwork, right? Companies operate on relatively similar timelines. Farmers do too, but those industries are different, right? Really, the only good metrics in an ag business are year over year. Month over month are pointless. Quarter to quarter are pointless. In a consumer business, those velocity metrics and other things are really what matters. And in SaaS business, enterprise, they matter too. In ag, it's a bit of a different story.
Do you feel that most of your investors understood that by the time they invested, or were there some who still had to learn that over the years?
I think they understood it, but I think there's a lot of people who weren't prepared for the reality of what it could, like the fact that volatility goes both ways. You can have a lot of growth, but you can also have a bad day. And, surprisingly, sometimes even investors who think they know a lot about the industry, they just don't have the stomach for it. I mean, it goes back to like the risk thing where you have to be willing to take a meaningful amount of risk to get a reward. But, you have to recognize that things don't always go perfectly and it takes a long time. I mean, almost every great investment I've been involved with, investment or company, has been on either death's door or has had very, very troubling times. As a small, medium, large business, it's just every single one. I know there are companies that never experience that, but that's more rare, I think.
Yeah, I think it's very rare. When you look at the most successful companies, they all historically have had at least one, if not two, of these kinds of moments. A lot of them have had acquisition offers that either they wanted to take and they fell apart, or they turned down, and that proved to be the correct decision. It's never been straight up and to the right line.
It doesn't work that way, and I think when in something like agriculture, where it can be violent changes or violent turns, it's also a very traditional industry where, I mean, in that world, in the consumer world, people will very, very clearly and perfectly accept a 27-year-old as a CEO of a company. It makes perfect sense. In the ag world, they think everyone needs to be a 65-year-old retired executive to be a CEO. And I personally, I don't agree with that. I actually think, just like every other industry, most of the time innovation comes from differentiated thinking and outside thinking, but it's a traditional industry. I mean, probably one of the most traditional. And, a lot of times if something, is hard, you revert back to that, even if you know the industry. If you don't know it, and you invested, you're very concerned or frightened of the dynamic at play, right? And that's part of it. And look, going back through, like, I can tell you about the seed company I'm on the board of, same thing. I mean, gosh, some of the tough times relative to how well the company's performing today, you almost forget. Beyond Me, same thing. FBN, same thing. It's sort of an across the board thing, at least in that industry.
With FBN, how did you find the data network or data analytics business model in the first place, and then what led you beyond that to other business model, other P&L lines?
Well, we found that as a result of the technology, the potential in the technology. So it was really a result of examining the data that existed in the machinery. All of that data was already there, and that was a realization. And then with computing costs and capabilities increasing, costs coming down, you could take massive amounts of data, and those machines do produce massive amounts of data. Take other pieces of data like satellite images, whatever it might be, and put them into a data set that gave you just tremendous analytics. Like the insights you could get were really amazing. The reason that wasn't the permanent business model of the company is it turns out that, from a farmer's perspective, paying any significant amount of money for that is still a hard sell, because in a year-to-year basis, what am I concerned with? I'm concerned with financing my operation, buying my inputs at appropriate costs, making good agronomic decisions, having my machinery and labor ready to conduct my planting, my spraying, my harvest, and then ultimately marketing my grain. And those are the concerns, right? And yes, those data analytics could help in every single facet of that, but how do I value that? How do I price it? It wasn't a game where we felt, despite how we were really the first to have, machine learning driven analytics in the industry, the kinds of technologies that you see pretty rampant everywhere today. But selling it and monetizing just that to a farmer was not easy. And so we had to move beyond that as a business model, but not as a premise for the business.
When you think about all the places you went to with the business model, how did you sequence each of those? Because FBN did a lot of things, or does a lot of things.
Yeah, I mean, you probably made some mistakes on that, but we sequenced it by looking for things where we could get into the market. I mean, as a company in that industry is full of monopolists, whether it's seed businesses or chem businesses or fertilizers or machinery or whatever, even grain to a certain extent. And so, like a new entrant with limited resources, limited capital, where are you going to be able to play? What wedge can you play in? Because everywhere you go, there's again a monopoly or an entrenched player sitting there who's, unlike the tech industry, the concept of integrating, creating a better platform for all, a bigger pie. The ag industry doesn't think that way. Everything's a turf war. And so we knew that, and we had to find a niche, a place where we could start to monetize. We did that with inputs, right? Looking back on it, I think I would have done it a little bit differently. I would start with financial services. I actually have a new venture where we're doing that, but for a lot of reasons. But we went where we could, not necessarily where it was ideal.
How did you get adoption with new products for these core aspects of a farm when customers are traditionally pretty conservative about trying new things?
Well, that's just it. They're not conservative. Like if you go to the farmers I know, that they're sort of utterly willing to hear about new things. I would almost put it on the far end of interest, both intellectually and from their own operation. Why? Part of it is, I think, intellectual curiosity. I think these are individual small business owners, and they're curious about things that can help their own business, but in their own trade. They're also tradespeople, right? They're experts in their trade, but they want to know about what are the new innovations in this area. And the second is, sometimes you need these innovations because those same monopolies, right, are compressing the income of the farmer as well. And so they need innovative tools that can disproportionately allocate value to them relative to one of these monopolists that they're trading with. And those two reasons make it actually pretty easy to get a farmer to consider adoption. I actually think that's where this industry ranks pretty high in the willingness of these parties to try new things.
If I recall, you also thought about going, right when everyone's going left, in the sense that, at least with seed, I remember the move overall seemed to be higher price seed, all these interesting traits and modifications. And you all said, well, if the price is low enough, you'll still make more money using seeds without all of the fancy innovation.
Well, seed, look, if there was ever a monopoly in the American industry, and I'm shocked by the FTC and everything, Neil, like they go after things that I don't think are monopolies at all. Like Amazon lowers my costs on just about everything. And yet the seed industry has like never been challenged by the FTC. It's like the biggest, most obvious monopoly on earth. So high price seed, the thing is, if one or two parties own and control all the underlying genetics, all the traits and all the IP, they can price it however the hell they want, which is exactly what happens. It's not high priced, it's priced to perfection for the owner of the intellectual property. And those are the laws, right? In the US, like we have intellectual property laws, people patent things, they own it. But there isn't really any room to innovate in that sector. So there's only one place, again, you can go. If you have to go through the process of developing your own genetics, which for me, I was willing to do. Like I'm doing that in another business where we've been tremendously successful, as I mentioned, on vegetable side. It is a long-term process. Like you can't lose your nerve on that. You can create tremendous value over time, sticky value. Like you're not going to be able to do that overnight. And then when you get to the market, how do you win market share? You have to price effectively to get farmers to try, because they do trust and find the seed that exists reliable. It's just overpriced, and it's priced to perfection because there's two parties that control 80% of the market.
Do you think that the approach to e-commerce and just fulfillment also had an impact on adoption?
I do, but I also think that is very, very challenging. I think, again, this is another one where if you make the decision to do that, you can't lose your nerve, whether you as an entrepreneur or your investor base or whatnot. Like there's going to be hiccups and difficulties along the way. Building a fulfillment network and an e-commerce network for agriculture has, I think, tremendous value and could be a value. We used to get compared to Amazon, a lot like Amazon, but you have to fight through the inertia to get to scale. Like you can't just run for the hills the minute that something doesn't work or you have a bad day or a bad year. I mean, 2002, this was Amazon as well. It's 5-6 years into their life. They almost went out of business multiple times. And it takes time to get to, because a commerce network with a logistics infrastructure is a scale game. And without that scale, you can't make the economics work. You have to fight through and get there. So I think it was driving adoption, but I also think that, it was still subscale. I mean, you had a ways to go to get through, to a scale that you get not only the economic benefit, the customer benefit, and then ultimately the bottom line financial benefit.
You also did something pretty clever, if I recall, with helping farmers analyze different seeds that were not being sold by Farmers Business Network, being sold by other companies.
That was actually really interesting. And I think that's an example of a service that, or analytics that I think someone should have been willing to pay for a lot more money, because it was a very objective analysis. I mean,
can you explain it for folks who don't know?
Yeah. So look, if as a farm, if you submit to me your files from your machinery, I already have a map of your soil data. So I know the textures of your soils. I have an algorithm about the weather and the periodic weather events that are happening on your farm. And then with that information you submitted to me, I have knowledge of your farming practice. And of course, that includes the genetics of seed that you use. So once I build a big enough data set, I can compare and contrast those. And as an example, our data science team would be able to tell you with P95 certainty which varieties specifically of seed will work best on your soil given your farming conditions. That took a lot of data to do. It took a lot of technology and engineering to be able to make that work. And it was very objective because it wasn't actually based on anything we were selling. It was really the analysis of the inputs, the goods that you were using from other parties. And there were regions where we had tremendously rich data sets. I mean, one of the hard things about that, though, was depending on the region, you had more or less data. Illinois, Iowa, Nebraska, South Dakota, we had tons of data. You got to Texas, we didn't have very much. So that service was less useful there. But in the regions where it was useful, I actually thought that was one of the best utilities we ever provided. But again, it was hard to monetize because the sales rep and the local person is telling you maybe the same thing or maybe something different. It depends on whether it's what they want to sell you. And as a farmer, you got to figure out which to believe. Now, I would personally want to believe the most objective opinion, but that isn't always the case, and you don't always have time for that. Or a lot of farmers, look, the system was also very technical, and a lot of farmers don't have comfort, going through all of that stuff. A lot of humans don't have comfort going through that level of depth. So there's probably things we could have done to simplify that better as well. But it was one of the more unique innovations, in my opinion.
There's also, I think, like a tactic that some of these oligopolies or monopolies have used of building very long-standing, deep relationships in communities with the people who are retailing their products, right? So when someone's giving you advice and you've known them for 20 years, the advice may not be good for you, but it's hard for you to not take it for a variety of reasons.
Well, I mean, I remember a story once where, when we were first starting to sell products, 2015, 2016, I used to do some of the sales calls myself. And I was on a call with a farmer where I gave him the price transparency, all the data analytics that we give objectively. And this was for commerce as well as seed. And he came back the next day and said, you know what, your data alerted me to the fact that the retailer that I've been working with for 30 years has been ripping me off. Like, I went back and looked at, like, me and my dad have been farming. We've probably shifted $1 million of wealth, millions of dollars of wealth into the pockets because we never shopped around, because we always trusted our local guy. And he says, I want to do this. We're going to buy something from you, so on and so forth. So I priced out an order, and this was as we were getting our tech system still up and running. We had manual stuff we were doing, and it was $200,000 sizable order. And he came back to me the next day and he said, look, I want to thank you for everything, all the work you did, but I'm going to go and buy from my local guy. And I said, well, you just told me yesterday that they were ripping you off for 30 years. He said, yeah, but they decided to match your price and beat it. So sunk cost is a real economic concept, right? And that is something you have to your point about oligopolies, they know that. So they're entrenched, and if they have to ultimately retreat to matching the price or dealing with it, they can.
I want to talk about a few other things. So for FBN, I also want to just give you just the opportunity to talk about your exit from FBN and founding the next thing.
Well, look, I didn't want to leave. I would never abandon my post. As an entrepreneur, sort of my feeling is whether things are good or bad, you simply don't exit ever. In fact, that's my hard and fast sort of rule. So tough or not, I would have been there. But board of directors decided to replace me. I was replaced with a representative of one of the investors. And then, eventually a lot of things happened. It's been 18 months. My kind of view of it was disappointing from my standpoint, because I actually strongly believe that a company like that should not only exist, but should be a sizable entity and a force in that industry. But, my ability to influence it, my control over that situation was very limited. And so, I had to accept it. As I mentioned to you, I was also fired from Kleiner. The world isn't a meritocracy, and at the end of the day, you could perform really, really well. You could create a lot of value. You could be in it for the right reasons, and it's just not going to go your way. So my exit was disappointing, and I didn't want to go. But, at some point or another, you have to accept the reality. And so, 6 or 9 months after that, I went back and I said, do I want to be an ag or something else still? After 20 plus years, I'm now a middle-aged entrepreneur, and I'd been investing for my family office for years. And my decision was that I want to be in something new. And I launched a healthcare business. I care a lot about the healthcare industry. I care a lot about autism specifically. I have a son with autism who we did an early intervention with, and has made remarkable progress. And for me, that's sort of meaningful, right? To be able to go back, and I invest in a lot of companies in that sector to do something worthwhile. I don't need the money. I can do something purely for this reason that I want it to exist, and I want it to be something worthwhile. So I decided to do that. The ag industry pulls me back in all the time as an investor. So for example, I just we did a new venture with a really, really talented CEO of a farmer-owned co-op called Landis, a fellow named Matt Karstens, and we've known each other for a while, and he's an innovator in the sector. And the farmers that own that cooperative in central Iowa, very innovative farmers, very capable farmers, we decided to create a new company together where we're bringing very, very fast technology development. We're bringing a process where a farmer can get approved for financing in a matter of minutes. They can buy products transparently. They can work through a network of retailers and others. So it's sort of a new concept, and the backbone is really, really innovative innovation. And the backbone is a cooperative system, which to me is unbelievably interesting. So these are the things I have been investing in. And then from a day-to-day standpoint, I've really decided to focus a lot of my energy on this new industry in healthcare and, learn how to impact that. And, been building, and we have a company still stealth with hundreds of employees now, growing fast, and hopefully soon to be more public.
Where do you see the opportunities in healthcare? What do you think is the untapped opportunity or the place to be building?
Well, I think that everything in healthcare is an opportunity. I mean, it's 27% of the GDP. It's shocking, and almost all of it's underserved. That's a part about this market that, as an objective outsider, that I find just incredibly compelling. And I can tell you in the early childhood development space, like autism, speech and language disorder, ADHD, occupational therapies, all these things that younger kids and preteens and teens need, massively, massively underserved. I mean, to a shocking level, year-long wait lists, 2-year-long wait lists. And I think that is potentially one of the biggest tragedies in the healthcare system, because those are actually areas where if you had the services available, you could have a massive change in trajectory of a child. I mean, thank God that we had the wealth to not have to sit on a wait list when my son was 2 years old and diagnosed with autism, because, your brain is developing at such a rapid rate when you're younger. And if you're able to get into therapy, I mean, today I find myself shocked. Most days I don't even know that he has autism. I treat him like a normal kid these days. It definitely wasn't the case when he was 2. And I wonder, like, had I not been able to buy access, where would we be? And that's why I have a passion for rural communities, serving rural communities with healthcare, serving inner city or underserved communities, people who, are just not getting the access to the care that they need. But I actually think that's the whole world, because when I was in the Bay Area and my son was diagnosed with autism, it was going to be a year-long wait list if I didn't pay out of pocket. And again, thank God that I had the money to do so. But I think that the whole industry is wrought with opportunity, but that's also a tragedy. And I, hope that more entrepreneurs choose it. I actually find it great that a lot of entrepreneurs have built something or been successful choose to focus on this industry, because they all have some connection to it. You had a parent with cancer or Alzheimer's, you have a kid with autism. It's like everyone, it touches everyone. And so it's easy to be passionate about. It's also an industry, is one other thing I love, is you don't have to explain to people about how it's ESG or this or that. It just is, it's like I have some investors who are making the argument to me that, like, launching a rocket into space is ESG. And I was like, how, what, maybe it's easier to talk about what doesn't qualify if that does. But in healthcare, I find that everything, it's just one of those professions. So it makes it easier to find talent, find those, passionate, mission-oriented people, both on the investor side as well as the employee base, co-founders, all of the above.
I couldn't agree more. I also think there's just so many unsolved problems in terms of diagnosing every disease. We don't know how to do that. How to treat every disease. We don't know how to do that. Even the diseases we know how to diagnose and treat, we don't have enough doctors and nurses to see every patient, right? As you're mentioning, with these wait lists. And so there's so many opportunities to innovate and to create more abundance. And that's what we invest in mostly. I want to talk about, we've about 10 minutes left here. So I want to talk about a couple of things. The first is just advice for entrepreneurs who are fundraising for the first time. What do you think is the best conventional wisdom out there about fundraising?
About getting it done, or about selecting an investor, or both?
Getting it done, right? Let's say someone who's never done it before, they don't, they're not coming out of Kleiner Perkins with a blank check. They have to figure out how to meet investors, how to get people interested, all that kind of stuff.
Okay, I'm just going to give the practical advice of the day, because times have changed. You're not dealing with a venture capitalist, you're dealing with a venture analyst. You need to give them information to analyze. Showing up and explaining your brilliant degree or your technical capabilities or how you worked as a product manager at this company or that company, I don't know that anyone's going to care. What they are going to care about is, Did you find customers? Did those customers buy the product, and at what rate are they buying the product? And then actually, and surprisingly, even at the pre-seed and seed stage, it's quite a bit of financial analysis. Like not only did you find, but what's the margin? What are the unit economics of it? Again, in the past, I mean, I sound like an old man, but in the past, you wouldn't ask those questions because anything I would tell you would be speculation. You clearly didn't have margins because there was no way you could. You just started. However, these days, I think the bar is a little bit different, the way that people look at these things. I mean, you can get more money at an earlier stage, but you need to prove a lot more. So the main advice that I give is don't go talk to investors until you're ready. Now, there are scientific level innovations that you don't need that. I have a couple in biotech space, things that are in like autonomy, like some levels of science where people just have to realize like you're not going to be able to sign customers and generate revenue within 3 months of starting. It's not going to happen. But outside of those ventures, in general, you actually need to build a viable, discernible business with financial metrics and present that to the venture analysts so that they invest. That is what you need. You do need a team. You do need a very compelling pitch. Those are just obvious. I mean, the compelling pitch, there's actually a lot of entrepreneurs who get into it and they probably shouldn't be entrepreneurs. Probably out of my 40 plus investments, I've got at least 10 or 12 of those. And sometimes I tell them, like, look, this isn't a gig for you. You don't have the stomach for it, or you don't want to sell, or you don't want to share your vision in a way that infects the investor, that gets them on board, makes them realize you'll never give up on it, makes them realize you'll run through a brick wall to make sure this happens. Like if you don't convey that, if it's not innate for you, it's hard to go raise money. And in that kind of entrepreneur, you need a lot of proof of revenue and monetization. So that's the 2024 advice. If it was 16 or 17 years ago, it'd be different.
Yeah. Times have changed. What would you say is the worst advice that's out there? The thing that people talk about as conventional wisdom, but you think is just incorrect?
I definitely don't like the go talk to 600 people and whittle down the funnel, because everyone's saying you got to get out, because I also don't like the start a year before you need the money. Like these are like easy statements to make, and I give you very important reasons why that you shouldn't do that. Everyone in this industry gossips with one another. I once wrote I write a newsletter and on LinkedIn, and I have a decent number of followers now. And one of the more popular posts was I did this Rosetta Stone of venture capitalists, and I will tell you that any information you put out there is going to get around. So if you talk to 600 people, probably 200 of those connections are going to know each other, and 100 of those are going to know each other really well. And they're like the amount of conversation and talking, you should take a discerning approach. Like go to your current investors or your advisors or your network and get warm connections. Put in the time, right? Not the 30-minute pitch. Do you like it? Do you not? I really dislike that approach. I like the hard won approach of saying, let me go be more discerning and put in more time. Okay, you still may get rejected either way, but you're treating the money as a commodity when you go and spray 700 conversations. Like I've never done that, and I've never recommended it.
Is it not a commodity though? Is capital not at this point a commodity?
But if it is, Neil, then I think you're looking at it the wrong way. Look, going back to, you asked me about my exit. The other thing I tell everybody is you got to select your investors really, really wisely. Okay, it's not just about getting the money. Like if you get the money from the wrong people, or people who are at the wrong stage in their career, you're going to fail. Like one way or another, that's going to come back and bite you. If you take money in the context of an investor becoming a board member in your company, you need to know how they think, how they act. The investors who are in my new company are like phenomenal. Like I spent the time to think about the partnerships, the people who I really know will think big. I didn't have that before, right? And also the age ranges of investors. I really tell my entrepreneurs, like, try to find someone who's within 5 to 10 years of your age, either way. You have someone who's 30 years older than you and from a world from the past. I mean, good luck. Like you're going to grow, but they're not, because someone who's 70 years old is not changing. And I think, so I don't think money is a commodity. And I never felt that about venture capital. I think that as you get to like the super late stage and you go public, maybe we're talking about a different story. But in the early stages of a company, my gosh, it's probably the most important thing, and it can make or break you. It certainly did for me. And, even at my age, I can learn. And that's, what I'm doing. right? In terms of as I dole out advice and also as I build a new company or multiple new companies.
Well, let's do a quick session here of just rapid fire questions to finish things out. I appreciate all the wisdom you've shared so far. These will be a mixed bag. So the first one is, if you have to eat one food for the rest of your life, what would it be?
Pizza.
Easy. What's the hardest lesson you've learned in your career?
Select the people around you wisely, not those that are easy to get. Surround yourself with discerning but unbelievably committed and supporting people.
Yeah, it's a good one. Who are you voting for this year?
Okay, that one, I would say I have not made up my mind yet. But one thing I will just say very candidly is I'm glad that, at least in our circles of venture capital, there's at least a little bit more debate about who to vote for. And you're not necessarily a bad person, depending on who you do, but I haven't made up my mind.
Yeah, fair. What's been the best moment of your career so far?
Well, I will put it into moments, okay? The thing I enjoy the most from my career is when I see one of my old colleagues start another business or be successful in their own right. It makes me feel like I did something of value. You know, you can value the company by its valuation or what you built or the size of it, but there's so many people I've worked with who've gone and now started their own ventures, some of which I've invested in. So in my career, if I see someone else growing, being successful, and I played a hand in that, I love that. That is probably one of my more number one senses of joy. Going back to when I was an investor, my old colleagues starting their own funds and doing these great things, employees who work for me at FBN, others I've encountered along the way. That's probably the highlight, seeing others be successful.
That's a great answer. Last question for you. Who's helped you the most in your career to get to where you are today?
Well, I got to give a lot of credit to honestly, my old boss at Kleiner, Ray Lane. You know, I was close to a nobody when I was out of college and grad school. And by just good fortune, I would say that, you know, the venture industry was interested in the things that I knew something about. And at that time, Kleiner Perkins could have hired anybody. And Ray and a few other partners there, you know, saw enough potential in me to hire me. And that was my ticket to the big time. You know, I don't have any ill will about being fired, about all the things that have happened, because, you know, I might have never been there. And, you know, you do need some dumb luck in your career as well. I think one way or another I would have found my way to success, but, you know, having someone who believes in you. So Ray, and he retired from Kleiner. He's at this new firm called Great Point Ventures. But if there's one person I could point to that really elevated and gave me a shot, it would be him. And I really regret when I left Kleiner not vehemently asking for him to be involved in the rest of the things I did. He was kind of off in other things, but that one is very obvious. I don't think I'd be where I am if it wasn't for that. So you got to have someone who believes in you to begin with.
Yeah, I've heard some great stories about Ray, and multiple people sing his praises. So that's a great answer.
We've done that for others too, not just me. So.
Yeah. Well, Amol, thank you so much for being so candid and taking the time with us. I appreciate it.
Yeah, and congrats to you on all the success ramping up and all the cool ventures and everything, and on this podcast. I'm glad to be a part of it.
Yeah. All right. Thank you.
You bet. See ya.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.